Michael McGlone, the great correlation on gold that's missing is the blowout in our debt, and frankly, the blowout in the deficit as well. Is that correlated with gold?
Yes. Hello, Tom. I know you love my multi-axis charts. I have to control myself there. But the key thing I think people remember about gold is compared to the big increase in U.S. debt to GDP this year, gold is basically unchanged this year. It's not really up a lot. It's unchanged since 2007. So to me, gold is doing what it's supposed to do. It's keeping up with debt to GDP, but at some point it's going to accelerate, and unless you expect debt to GDP and QE to go down, gold has to appreciate. It's just a matter of time.
But going back to Heilbronner here, and this is really, really important, is the distinction between the level of debt and the growth of the debt. Which is it that links to gold?
Well, there you go. It's the level and the growth, both. Most notably, the growth. It's when the growth of debt really picks up like it has this year. Let's look at this year. We're about 140% debt to GDP. Last year, we were about 110. So that massive pickup is what happened in 2008. Now, gold initially had its bounce, its dip, and then it catches up. So I think it's in the catch-up stage. Obviously, just made an all-time new high. A little bit overbought in the short term, but just give it a little more time. It should continue that rally. Remember, gold's in a nascent bull market and had a very long period of disdain and underperformance, and then compare that to the other side of the aisle. The stock market's in a really extended bull market that's been around for a while and it's getting old.
Mike, I love talking with you because you are one of the only people who will say I have to control myself about the multi-axis charts that I have. And yet here we are, Mike. When we talk about gold, we have to also talk about real yields and how negative they are. A lot of people saying that negative real yields was what was pushing a lot of people into gold. Real yields have actually gotten less negative. How much is this the real story behind the gold weakness?
Well, that's the key story, but I kind of look at that with a bit of a grain of salt. Real yields are reflecting the fact that CPI and most inflation indices are very much lagging. They will catch up, and they're going to zero. It's just a matter of time. That's where they're heading. Bond yields have been going to zero for a while. We started in Japan, then we had Europe, and now we have the U.S. To me, it's just a matter of time. What it's going to take to end that, I don't know. And the key inflection point I'm worried about to get to negative yields in this country is a bear market in the stock market, which someday we have to have if history is a guide. Now, we haven't had that since 2011, or since 2009, where it goes down and stays down for a while. So I'm worried that's the next keen thing I'm looking forward to, unfortunately, for gold to peak, and I don't see it for a while.
All right, Mike, if we see this bull market in gold continuing, as you say, the path matters, especially for people looking for a ballast to their 60-40 portfolios that appear perhaps antiquated with yields as low as they are. Based on moves, gold has moved in tandem with equities. Will that continue?
Well, let's look at it on a year-to-date basis. S&P's unchanged, and gold's up about 23%. Bitcoin's up almost 50%. So depends on how you look at it. It's how you look forward for the next 5 or 10 years, and I see the better value with debt to GDP at all-time highs, QE only going up, and the stock market at the highest level versus GDP ever. That I have a sense we're going to see some flows going back towards the metal. Remember, gold used to be a big portion of portfolios back in the 70s and 80s. It's probably going to go back that way with just the normal cycles.
Michael, one final question. I got to go back to Dr. Copper, and of course, closely linked to Australia and particularly to Chinese dynamics as well. Copper's been what we call red zone, green zone for, I'm going to say, 4, even 5, even 6 years as well. Is copper tradable now, or is it trending?
Yes, well, it's trending. It's been a bear market, but Tom, I think we're very close to an inflection point. Copper right now has the highest correlation ever on a 52-week basis to the NASDAQ, to the stock market. So that's been what matters. If the stock market really goes down, copper will go down. But just this last few weeks, despite the stock market correcting from the highs, copper is doing very well, right around $3 a pound. So I suspect we're near that inflection point where, looking forward, it's really, from a commodity standpoint, the metals that are really attractive to me because of demand, and a lot of it is decarbonization in energy means more demand for all the metals: silver, copper, cobalt, nickel, all those.
Michael McGlone, thank you so much.